The rapid expansion of India's bond market is capturing global interest like never before. But here's where it gets controversial. Is this growth signaling a new financial powerhouse, or are there hidden risks lurking beneath the surface? International investors are rushing to tap into India's booming capital markets, and fixed income securities are at the heart of this surge, according to a recent analysis by Coalition Greenwich. Between 2023 and 2024, the total value of global market inflows into India soared by 12%, reaching an impressive $4.1 billion. Out of this, fixed income, currencies, and commodities, FICC assets alone accounted for $3 billion, underscoring the critical role these instruments play in the market. When looking at emerging Asian markets, India holds an influential position, representing an average 22% share of the FICC segment. This places India second only to China, which dominates with a 42% share, while Hong Kong trails behind at 8%. A particularly notable trend is the substantial rise in bond issuances denominated in Indian rupees, INR, this year. Coalition Greenwich especially highlights the uptick in local currency bonds issued by sovereign, supranational, and agency SSA entities. This has spurred increased activity in derivatives, contributing to greater market liquidity and a more vibrant trading environment. India's bond market is becoming a vital source of capital for corporations and infrastructure development as the economy continues its expansion, explained report authors Amir Hazaria, Bhavya Ahuja, and CRISIL's chief economist, Dipti Deshpande. This fundamental role could transform India's financial landscape, but how prepared is the market for such rapid evolution? Access for investors is getting broader as well. Currencies like the euro and the Japanese yen are gaining traction for funding optimization. And inclusion in global indices has triggered a rise in total return swap transactions. This trend points to increasingly sophisticated market instruments and deeper integration of Indian bonds into the global financial system. Manual trading practices, once the norm, are evolving quickly in response to growing international appetite. For example, MarketAxess launched electronic trading for Indian government bonds in June, marking a key shift towards modernization and efficiency. However, this growth doesn't come without challenges. Regulatory bodies like the Securities and Exchange Board of India, SEBI, are stepping up oversight, illustrated by their recent ban and hefty fine on Jane Street after probing the firm's activities in cash and futures markets. This incident highlights the complexities and regulatory challenges of managing a fast-developing market. On the corporate side, private credit is increasingly the go-to route for raising capital, especially as foreign investors look for yield opportunities in India. Private debt funds have witnessed astronomical growth, from just $0.7 billion in assets under management in 2010 to a staggering $17.8 billion by 2023. Making private credit the fastest expanding alternative investment class in the country. The rapid scaling of this sector opens the door for innovative financial products such as deal contingent swaps and options, which could enhance risk management and investment strategies. To sum it up, India's unmatched growth momentum, coupled with its strengthening market infrastructure, positions it ahead of many global counterparts. This creates a compelling scenario for banks and investors eager to leverage favorable macroeconomic trends and a transforming market environment. Yet this transformation also poses critical questions. Will India's market reforms keep pace with growth? And how will international investors balance opportunity with risk? Your thoughts matter. Do you see India's bond market as a safe haven or a potential gamble? Share your perspective in the comments.